Afternoon. Over the past couple of days in our grade 12 economics class, we have looked a little bit at a new unit which looks at money and banking. And in particular, we've touched upon a couple of important themes. We've looked at where money came from historically over time. We've also looked a little bit at where banks came from, and we've talked a little bit about just why money is so important within the economy in a modern day. Today, we're going to start to look a little bit more at the picture of banking. And in particular, in doing so, we are going to look at a couple of important themes. And we'll actually spread this over a couple of lessons. The first theme that we will look at is just the different kinds of branching or banking models that you might see in different parts of the world. There's many different banking models, but we'll look at two theoretical examples, which is what we call branch banking, the more common system used in Canada, and then also a model called unit banking, which tends to be a little bit more common historically in the United States. Once we've talked about that, we'll talk a little bit about the overall Canadian banking system as an overview. And then finally, we will finish with a very important focus on how banks create money through their ability to give out loans. We'll start by looking at a monopoly model, where we'll look at a simplified economy which just has one private bank and how money is created within that particular system. And then we'll branch things out to a little bit more reflective model, which is the multi-bank model that looks a little bit more reflective of Canada today. We'll finish by talking a little bit about something called the money multiplier equation, which is a summary tool we can use in order to analyze the process and quickly sort of predict the process that we'll explore in question number 3. Banks are fairly important institutions. In Canada and other nations, banks play a very integral role in the management of the nation's money. They not only store money, but they also help clients transfer money between accounts and thus provide a method of exchange in addition to cash in circulation. Moreover, because of the fact that banks give out loans, and they give out loans often with money that really isn't their own, but rather is somebody else's money that's been deposited on their behalf, banks actually also create money in the economy. And similarly, if they take back loans, they pull money out of the economy. And we're going to look a lot at that particular process of money creation, money sort of deletion, and how the multiplier effect works in practice. And we'll use some accounting books to take a look at those things. There's two big banking systems that tend to be common in the world today, and those systems are unit banking and branch banking. And we'll explore each of those, and then we'll compare that to the Canadian picture. Unit banking is a system which grew famous in England, as well as to a certain extent the United States over time. It involves many small units or banks that tend to have a little bit more independence from one another. So think of a lot of small banks competing and not really having overlap between those banks, having a lot of just small independent ones. The benefits of having a unit banking system is that it tends to create a lot of local sort of charm for banks. It tends to create a lot of opportunity for reflection of local interests, and also creates, because there's so many different banks, good competition and good sort of rates for the consumer in question. The challenge of unit banking, though, and this is one of the reasons why a lot of countries, even including where it grew up in places like England and the United States, have to a certain extent moved away from unit banking over the years, is that it tends to be riskier. And while you tend to have good competition and good opportunity in times of struggle, where banks may face a lot of pressure, particularly from people who may not trust them and want to keep their money within a bank, there may be runs on banks. And when you have a lot of small banks, they may not have the assets to pull upon to sort of maintain stability in those scenarios. And so that's why in many cases you will have what we call a branch banking system. It's traditionally the Scottish model. They often look at the UK and the very different model that existed in Scotland compared to in England. You also, to a certain extent, could call it a Canadian model because it's really been our reality since the beginning of our modern economy. The branch banking system does involve lots of local banks, but the critical distinction is that the local banks are usually what we call branches. They're not independent entities, but rather they're parts of a larger whole. And they're kind of like satellite banks that exist, but only to provide services at a distance wherein most of the assets or the funds are collectively held by a large bank in the center of the country. The advantage to having this system, where you have a few big banks that have a lot of branches, is that you generally have a lot of security. And certainly in countries like Canada and others that have had branch banking systems, we've often had a very stable, very reliable banking system, which has provided a lot of good security in case there's been times of trouble. And certainly during periods like right now, where we have a recession, or 10, 12 years ago in 2008 and 2009, where we had another major recession, put a lot of pressure on the banks. Many respects, Canadian banks have always been pillars of stability during those periods, and have generally been quite strong in resistant to risk. The drawback, though, and it certainly is a complaint that some people have had over the years, is that when you do have just a few big banks controlling many things, you tend to have less competition, weaker services, etc. And while most people would praise the Canadian banking sector for its stability, you probably wouldn't hear a lot of people suggesting that Canadian banks are extremely competitive and really eager to give their customers the best possible rates. There is a little bit of a trade off, and certainly that is part of the picture. As I've mentioned, we've almost always had a branch banking model throughout our history. And even though the Bank of Canada and the government has tried to at least open up a little bit of competition over the last 25, 30 years, and they've tried to introduce the opportunity for some new banks to really start out to compete with the more traditional ones that have always been there. Typically speaking, the vast majority of banking, at least at a private level in Canada today, is controlled by a group of just a few banks. Most of the banks are not very large. There's only a few that really dominate. Uh, Along those lines, in April of 2020, if you were to actually look at the official list of banks in Canada, or what we call chartered banks, institutions that can do everything that a bank is allowed to do, there's actually over 70 of those in Canada, but there's only 6 banks that control over 90% of the actual banking activity. Now, as I take a little bit of a break to catch my breath, I'm going to give you an opportunity to pause. I want you to think about, what are those 6 banks? What are the banks that generally define our industry in Canada today? All right, had a little bit of time. Here are the banks. The 5 at the beginning are probably ones that you're quite familiar with. So Royal Bank, CIBC, Toronto Dominion, Bank of Nova Scotia, Bank of Montreal. The 6th, maybe a little bit of a surprise. It's actually smaller than the other ones. In fact, it's no larger than half the size of the smallest on that list of the first 5, but it is quite prominent, at least within the province of Quebec. And so for most provinces, you would only list the first 5. But if you started to look at Quebec, Quebec actually does have a few of its own banks that are quite large in terms of the local provincial affairs. And so National Bank, and to a certain extent Laurentian, sometimes they're kind of squeezed in. And sometimes they talk about the largest 5 or maybe even 6 or 7 in Canada. You will never need to know this, but if you're curious about the overall size of banks and just how they compare, the statistics on the screen here will give you a modern sort of picture of things. You'll notice that Royal Bank and TD are by far the largest banks in Canada, and then Scotiabank, Bank of Montreal, and CIBC are quite large, but still a little bit in the rear. These are some of the biggest companies in Canada today, and in fact, they're also very international companies. A lot of that money comes from investments, not just in Canada, but also to a certain extent in other parts of North America and even overseas. Certainly, the fact that we have these large banks, it stands out a lot. And if you're looking for just blue chips to put your money in terms of the stock market in Canada today, the banks are no doubt at least 5 or 6 of those big institutions that would make that list of stable companies that you can invest in and know that you're probably going to do okay in terms of supporting. And these are just a list of the other banks. And I don't care if you know all this, just understand that there's a lot of them. There is a little bit of a debate, which we're not going to get into a lot of detail with in terms of today's lesson. Is 5 too big? Should we have less than 5 and be even more competitive internationally? Should we actually open up having more banks having more opportunity to compete? There had actually been an effort a few years back in the 1990s to actually conglomerate even more and have 5 banks turn into 3 as 2 of the banks, or actually 2 pairs of banks merged. The government, though they have to approve any of those kinds of mergers, they ultimately looked into the issue and they said no. And the argument the government had made is that even though that might create more opportunity to compete internationally, which is why those banks had wanted to do that, they wanted to be big banks on an international scale and not just a Canadian scale. The fear was that there'd be a threat to the overall needs of consumers who want to have competition and good services within their own local market. And so, at least at that particular time, the government had said that 5 it may not satisfy everybody, but at least a number that gives a little bit of a balance between those different perspectives. You can debate things if you want. It's not a really crucial topic for what we're going to be discussing over the next couple of weeks, but certainly there is a sort of discussion out there. Do we have too much of our money in just a few big institutions, or is it actually a good thing that we have that because of the security that it creates? Okay, so with that being said, we're going to turn our attention now to a new theme. We won't finish this particular part of the lesson today. We'll start it today and we'll finish it a little bit in a couple of classes. But we're going to be looking a little bit at how money is created within the economy, particularly through the process of banks giving out loans in terms of money that might be put on deposit that they have, but that they don't actually have title to. In order to show this process, we're going to start off today by looking at a hypothetical private bank, which we're going to call a monopoly bank. Now, you can probably guess we're going to call it a monopoly bank because we're going to assume that it's a situation where it's a private bank that is the only bank that exists within the country. And that, of course, creates a number of critical sorts of variables that will go into the model as we move on. Is this realistic? Sometimes, perhaps, not within Canada, though. Canada actually has what we call a multi-banking model. There's many different banks that people can use. We will look at how money is created within that particular model, but we'll do that the next day after we've established some of the basic parameters with the simpler monopoly bank model of this class. As we look at the Monopoly Bank, we're going to create an accounting balance sheet to take an examination of what's going on. And in particular, we're going to create a sheet that has two entries. If you've ever done accounting, for every amount of money that goes into the bank, we're going to create asset lists. So for example, things like deposits will be assets because they're cash that is put in terms of the cash that's there. But there'll also be liabilities because whenever money is owed to a person, then that will have to be recorded as well. For every deposit customers make, the bank is going to record on its sheets an asset for the cash that is taken in, as well as a liability for the amount of the deposit, since in theory it owes money to the depositor if he or she asks for it back. In our first entry, we're going to show what happens when a bank takes in $10,000 deposit. That would look as follows. Okay, it's a fairly simple entry. You're going to create a cash asset, and you're going to create a cash asset because now the bank is holding $10,000, which it has title to, but it's not free money. The bank technically, when it takes in that cash, doesn't own the cash outright, but it also owes it back to the person who's put it in. And so we're going to create an entry on the other side as a liability because that person who has that deposit can theoretically come back, give in their deposit, and take their cash out at any point they want to. That's the whole point of a bank. They're keeping their money temporarily, but it's not totally being given up. Now, how is the bank going to deal with this situation? What is the bank going to do? If the banks were simply going to try to make money off service fees, then this would essentially be the end of the picture. The ledger would be complete. You'd have your bank in the money, or sorry, your cash in the bank. You would have your deposit. You would get a little fee that was going to the bank outside of that, and then that would be the end of the story. We know, though, that banks want to make fair amounts of money, and they're fairly large investment sort of, I guess, institutions that take a number of risks. And so they're not going to be satisfied to just take money and store it and get a small service fee. What banks are going to do is, however, that they're going to loan money out. Okay, and in particular, in our previous example, we're now going to see that some of that cash that's come in terms of the $10,000, will actually go out and it will be used to facilitate a loan. It could, in theory, loan all $10,000 cash and just give all the cash out all at once. That would create a problem, though. And you can probably guess what that would be. It would be that if you gave all $10,000 cash, all it would take is for the person to ask for a bit of their money, that they put the 10,000 in the bank, and you would have a problem. And so from that particular perspective, to avoid problems with running out of cash for people who are taking money out of their accounts, what the bank is going to do is it's going to decide to keep some reserves, but it's only going to keep a safe percentage of the cash as a reserve to guard against runs on the bank. The percentage that the bank keeps in readily liquid assets, so in cash, the cash that they're going to go hold on to, that's called, at least this is percentage, the reserve ratio. And the money that's kept is called the required reserves. Everything else beyond that money that's held onto as security will be left over to do things with, and that's the money that we're going to call excess reserves. For our first example, we're going to assume, and this is a standard assumption, although it could be different ratios for different banks, that the bank is going to hold on to 10% of its money as a reserve ratio. Based on that assumption, we're assuming that 10% is enough that if some customers ask for their money, that there'll at least be enough there. And yes, a person might ask for more than 10%, but you're not going to have everybody who has a deposit asking for more than 10 all at once. And so hopefully 10 is enough to cover the general percentage that might be asked for at any one point in time. With a 10% reserve ratio, the bank is thus only going to hold on to $1,000. The remaining $9,000, though, is going to be an excess reserve fund. And rather than securing the $10,000 that's currently on deposit for the first customer, the $9,000 is going to be free money because you don't need more than 10% to keep that $10,000 secured. We have that with the first 1,000. So the $9,000 essentially becomes an excess reserve fund. The bank is thus free, and this is where it gets a little bit confusing. So hopefully you can follow along. The bank is thus free to use $9,000 in excess reserves as a security deposit against a new loan. Just as the $1,000 is the security against the $10,000 that went into the bank initially, the $9,000 can actually be used not just to give out a loan, but in fact to be the cash that's held by the bank as a security against new loans. And so what's going to happen is that this bank, because it's a monopoly bank, and it knows that ultimately every amount of money that goes out will always stay within the banking system because everybody banks at their bank, they're going to actually use the $9,000 as a security against a very large loan. And what they're going to do is they're going to give out a $90,000 loan because they know that for every amount of loan that they give out, they need at least 10% cash always on hand. They've got $9,000 cash to secure the 90,000. That's 10%, and it will work out. And so essentially what's happened, and it's happened in all one quick swoop with the Monopoly Bank, is that in giving out this loan, it's created $90,000 in new money. Okay, because the $90,000 that they've given out as a loan was money that really wasn't in the economy before. We can see how this looks if you look at the ledger here. And when you do some of your questions for homework, you're going to have to sort of work with models that look like this. And this would be the end of the day for Monopoly Bank. Here you can see the Monopoly Bank has taken an initial $10,000 deposit and kept $1,000 of that $10,000 as required reserve in cash. That freed up, and these are sort of subscripts here, $9,000 in excess reserve money, and then that $9,000 is going to be used to give out a loan. But it's not just going to be the loan, because in this particular case, all money comes back to the bank inevitably. And so even if you give out a loan, that money will still come back through some other person's deposits. And so it's actually going to use that $9,000 cash as security against the very, very large loan deposit of $90,000. That will create an asset in terms of the loan because the loan is owed money to the bank, but it will also put $90,000 on paper at least into the deposits of the person who gets the loan. Now, might that person who gets the loan take that money out and might they transfer it to another person who will then put the money back in the bank? Yes. But because the money is going to come back to the Monopoly Bank, the Monopoly Bank actually feels fairly secure giving quite a large sum of money, even more than they had cash on hand for, because they know that at least in terms of the required cash, which is 10%, they've got it to secure not just the original deposit, but hopefully you can see this here. They've also got it to secure the new loan. So how does the bank get away with this? Well, no, they haven't just created money from thin air, and they haven't found a magical money tree. But rather, what's happened is that even though the amount of physical currency has not been altered, because people are trading money with checks and bank books, they've actually been able to, through their reserve system, create new money in an accounting sense. In particular, given that there are so many people using banks, they feel pretty secure doing this since they know that statistically speaking, and this is the critical variable, it's unlikely that all the people who have deposits in all different facets of life are going to come back and ask for all of their deposit money all at once. Even if one person asks for more than the reserve ratio, they'll still be fine so long as other people don't ask for very much, and ultimately they've got enough to cover the day-to-day requirements of being a bank. Now, a final couple of points. Because there are hundreds of transactions like this one occurring and co-occurring every minute, even if the 10% reserve ratio is not sufficient in one isolated scenario, it will be, and I've mentioned this already, over hundreds of transactions enough. And since most of Canada's banks are very big, default is not a major risk. As one last final safeguard, The Bank of Canada also does at least set rules, and they do tell the chartered banks, who probably wouldn't be too risky in terms of what cash they held on reserve anyways, but they do at least set what they call a minimum reserve ratio. And so if the banks were trying to hold on to just too little money and they felt like there was a risk, there actually is a limit that the Bank of Canada imposes. And that's a regulation to make sure that there is some security that's there. I haven't mentioned on the screen, but I'll also add in the Bank of Canada will also, up to a certain point, guarantee any deposits. And so again, if somehow the bank didn't have money at a particular point in time, and by the way, you can't take out millions of dollars all at once. There's a limit in terms of daily amounts, so there'd always be an opportunity to raise funds if you needed a lot at once. But even if somehow that didn't work, there is actually deposit insurance, and so the Bank of Canada would actually give money to the bank if that ever happened, just to keep the system from collapsing on itself. Okay, that's a very long, complicated lesson, so you may need a little bit of time to try to depack or unpack everything. What I would like you to do for your homework today is as follows. I'd like you to read pages 253 to 256 in your textbook. They talk about what we've just talked about today, and they go over it in a little bit more detail. You can ignore the examples on page 257 because that's what we're going to do tomorrow with the multi-banking model. Once you've done 253 to 256, all I want you to do for your homework is just questions 1 to 4 on page 261. And when you come in tomorrow, we'll take those up as a group. Thank you.